Hello, investors! A sound investment approach can produce positive returns over time, free up your time to concentrate on other aspects of investing, or even make investing so simple that you can spend more time doing the things you enjoy. In this video, we'll go over the top 5 investment strategies for new investors, along with some of their advantages and risks. Dollar cost averaging. The method of adding money to your investments on a regular basis is called dollar cost averaging. You could decide, for instance, that you can invest $1,000 every month. You, therefore, invest $1,000 each month regardless of the state of the market. You spread out your purchase points by buying an investment on a regular basis. You reduce the danger of timing the market, which is the risk of investing all of your money at once, by spreading out your purchase points. By using dollar cost averaging, you may make sure you aren't overpaying for something by obtaining an average purchase price over time. Dollar cost averaging is beneficial for establishing a consistent investment habit. You'll probably end up with a bigger portfolio in the long run, if only because you are methodological in your approach. One of the risks of this strategy is even if you avoid going all in at the wrong time by using continuous dollar cost averaging, you won't go all in at the right time. Therefore, it is doubtful that you would receive the best returns on your investment. Income investing. Owning investments that provide cash payouts, like dividend stocks and bonds, is known as income investing. You receive some of your return in the form of actual currency, which you may spend any way you choose, or you can reinvest the funds in other stocks and bonds. In addition to the cash income, if you hold income stocks, you may also be able to benefit from capital gains. Index funds and other income-focused funds make it simple to apply an income investment strategy, since selecting individual stocks and bonds is not necessary. You have the security of a consistent cash return from your assets, and income investments often vary less than other types of investments. Additionally, premium dividend stocks frequently see growth in dividends over time, increasing your money without requiring you to do any additional work. Income stocks are still equities and can decline in value even if they are less risky than other types of stocks. Additionally, if you invest in individual stocks, they may reduce or even eliminate their dividends, leaving you with no payout and a capital loss. Given that you won't likely see much or any capital appreciation on them, many bonds' modest dividends make them unappealing. As a result, bond returns could not even outpace inflation, giving you less buying power. Additionally, you'll have to pay taxes on the income if you store bonds and dividend stocks in a standard brokerage account. Value investing. The goal of value investing is to select equities that appear to be selling below their intrinsic or book value. Investors that are looking for value actively pursue stocks they think the market is undervaluing. They believe that both good and bad news can cause the market to overreact, resulting in stock price swings that don't accurately reflect a company's long-term fundamentals. Investors might profit from their investments by buying equities at a loss after overreacting. One of the primary risks for value investors is overpaying for a stock. If you overspend, you run the chance of losing some or all of your money. If you purchase a stock near its fair market value, the same applies. Even when the firm performs poorly, your chance of losing money is less when you purchase a cheap stock. Building a margin of safety into all of your assets is one of the core tenets of value investing. This entails paying around 2/3 of their real value or less for equities. Value investors attempt not to overpay for investments because they want to risk as little cash as possible in possibly inflated assets. Buy the index. Finding a desirable stock index is the key to this method, after which you must purchase an index fund that is based on it. The Nasdaq Composite and S&P 500 are two well-known indices. Even if it's the only investment you hold, it has a number of the most popular companies on the market, offering you a well-diversified portfolio of assets. You may just own the market through the fund and get its returns rather than trying to outperform it. Purchasing an index is a simple technique that can be effective, especially when coupled with a buy and hold mentality. The weighted average of the assets in the index will be your return. You'll also take less risk with a diverse portfolio than you would with a small number of stocks. Additionally, because investing needs far less work and doesn't require you to research individual stocks, you may spend more time doing other enjoyable activities while your money is working for you. Although holding a diverse portfolio of stocks is seen to be a safer approach, investing in stocks may be risky. But holding on through the difficult times and refusing to sell is necessary if you want to reach the market's long-term gains, which, for the S&P 500, average 10% annually. Additionally, since you are purchasing a variety of equities, you will receive their average return, rather than the return on the most popular stocks. However, even experienced investors find it challenging to consistently outperform the indices. Buy and hold. The buy and hold strategy is a tried and true method that consistently works. With this approach, you do precisely what the name implies. You purchase an investment and keep it for the foreseeable future. Though it's ideal to never sell the investment, you should aim to keep it for at least 3 to 5 years. Buy and hold investing avoids aggressive trading, which reduces returns for most investors by focusing you on the long term and encouraging you to think like an owner. The performance of the underlying business over time will determine your success. And in the end, this is how you can identify the greatest winners on the stock market and potentially make hundreds of times your initial investment. Investors must resist the urge to sell when the market is difficult if you want this technique to be successful. You'll have to put up with the market's occasionally sharp declines, and a drop of 50% or more is probable, with individual companies perhaps dropping much more. One of the best choices you can make for yourself is to invest, but getting started may be challenging. Select a well-liked investing strategy that will work for you, and then stick to it. If the information in this video was valuable to you, check out the channel for more content on investing and personal finance.